In this episode, I had the chance to sit down with Nate Mallory, who is a good friend of mine, a tax attorney, a Navy veteran, a client, super smart guy. We had the chance to talk about all things taxes. Unfortunately, in the video, mine came across super glitchy. So I hope you can just kind of ignore those glitches, focus on the information. It's a ton of information. We deep dive into real estate taxes, 1031s. We cover business deductions, the Augusta rule, a bunch of really cool information. Obviously, I'll put the notes down, the summary, so you can jump around. And if you want any quick information, you can go right to that spot. But hope you enjoy. If you guys have been enjoying this information, if you find it helpful, go ahead and subscribe to this channel and also like the video. You can you hear us now, Chris?
I can hear you.
All right.
My computer rebooted last night, and
Oh, okay.
so I had to tweak some things and unplug and replug and get it all working again. But I'm here.
Cool. All right. Awesome. So, well, first off, Chris, Nate Mallory, Chris Smith. You guys are
Nate,
both
how are you doing?
attorneys. Chris is a business attorney, and he's been doing it for like over 30 years. And Nate, you are a tax attorney, and that's why we wanted to have you on, because there's so many tax questions, especially when it comes to mortgage loans and real estate purchases and stuff like that. So I'm like, dude, you'd be the perfect person, because I love to put out this content, like not only for my clients, but for myself. So when I forget things, it's like, hey, what can we write off? I have something to reference, and I'm not a CPA. I can't give tax advice. I have to always disclose that. It's like, hey, to the best of my knowledge, this is what I've learned, but I'm not a CPA. I can't give advice. Talk to your CPA. Obviously, everyone's situation's different, so we can't even use this information as as advice, but we can use it as a guide and for knowledge. So, I just wanted to really have you on and talk about, tax benefits of buying real estate, what you can write off on your mortgages. Can you write off HOA, property taxes, things like that? Those are kind of my questions that I had for you. Chris may have some questions as well that he wants to bring up. Also, when you sell your property, obviously, if you're married and you're single, you get tax benefits if you've lived in that property for 2 years or more. So let's kind of talk about all that.
Yeah, that sounds great.
So, first off, let's just go to the simple. Start with the simple stuff. So if I bought a house that I was living in, and then I wanted to sell it, if I wanted to sell it within a year, or if I want to sell it within 2 years, what are my tax implications, and if I'm single and if I'm married? So let's start there.
Right. So basically what you're talking about when you buy a residence and then you sell it in the future, presumably at a profit, what you're talking about is capital gains. And so without the exclusion that's included in the 2-5 rule, you'd be paying capital gains on whatever your difference in basis is. So if you buy a home for $500,000 and you later sell it, 3 years later for $1 million, your basis in the home was $500,000, so you would have a capital gains of the additional $500,000. So you have the 2-5 rule that a lot of people are familiar with, especially with married couples, because you always hear of the exemption being $500,000 of capital gains that you can exempt from selling a primary residence, so long as you've lived in it in 2 of the last 5 years. But what it actually is it's per individual $250,000. So if you're a single individual, or if you're married filing separately, it's $250,000 per person under the same restraints of the living in it as of using it as a primary residence for 2 out of the last 5 years. So you have a lot of people that will kind of keep that in mind when they change their primary residence to a rental property. They might live in it for the first 2 years, the first 3 years, and then rent it, and they kind of keep an eye on that 5-year window of, okay, they need to decide if they're keeping this as a long-term investment property after they go past that window, because after that 2 years that you've lived in it within the 5-year window is gone, now you've missed out on that exemption from the capital gains shelter. And at that point, if you sold it in the future, now you're looking at more of like a 1031 exchange, which is being able to move the capital gains tax event that you would have from one property and invest that money into an additional property to basically constantly postpone paying the capital gains on that initial property. So that's one that's very common for people. And you see a lot in California, just with how much real estate has skyrocketed over the last couple of years. Of I think when I had my home for only 4 years, the market went up almost $200,000 in that neighborhood. Just making minimal improvements even. So that's a pretty common one.
So let me ask you. Let me ask you a question. Sorry, Chris. If I buy the house and I'm the only one on title, but I'm married, do you still get that 250 and 250 because we're married and it's community property, or does it? Do you only get the 250 exclusion? Period. If I'm the only one on title, out of curiosity.
I'd have to double check that because I haven't come across a situation where that's been the case with clients. But the way the tax code is written is it's by the taxpayer. So but that would probably kind of be dependent on the exact situation of whether it's on title, and I'd have to look at if that's something that's specified in the code of whether there has to be an ownership, or whether if it's a community property or community property state that takes precedence on it. Because that's not something I've actually come across so far.
Okay. Chris, you were going to ask something?
Yeah, no, you brought up the 1031 exchange. I've had a few people approach me probably in the last 3 years or so who have rental properties in California, and they want to exit the state, and all of them have decided not to do the 1031 exchange as soon as they find out that California follows them. So you have to file with the state every year to let them know you still own the property that you exchanged.
It's
really
California's ability to chase taxpayers for money is almost impressive. You see it with their franchise board for the business fees. To give you a comparable of kind of that how much they come after those tax dollars, especially when you're talking about business ventures, and 1031 is a business venture. It's an investment property. To form, whether it's an LLC or a corporation in California, I believe it's $800 a year, and it's every year you have to pay that, whether you're profitable or not. Versus in Texas, for an LLC, it's $300 one time. I believe LLC is good for 10 years, if not in perpetuity from that. And California is notorious for chasing people down for that franchise tax, even if their business was not just not profitable, but took a loss. They're still trying to collect their money even years later.
Right.
And now they're doing that with real estate, I guess, huh? So literally, so what you're saying is, if I 1031 a state or 1031 a house, sell a rental property that I've owned for at least 10 or 2 years, I guess is what it would be. And then I sell that rental property, and then I 1031 into a Texas property. I have to file with California every year, letting them know I own that Texas property.
Right.
Is that what you're saying?
Well, not only that,
Dude,
but now you've got the capital gain that you earn in California on the California property. And then you move your tax basis through the 1031 exchange to the new Texas property. And let's say that Texas property, it appreciates in value. California wants the tax on the full appreciation. So that tax.
Let's dumb this down a little bit, so we all understand. So if let's just say I have an investment property I bought for $200,000, I now sell it for 500,000. So I got 300,000 net worth in that property or equity gained. I sell it. I make 300,000. Let's say if fees don't exist and real estate fees don't exist. So now I move that 300,000 into a Texas property, and let's say I bought that for 500,000 as well. And now eventually that property becomes $1 million. So now we're at what? We're at a total of 800,000 and equity total, and that's California's going to look at that. Is that what you're saying?
That's the way I understand it.
Dang.
Yeah,
And
and that's why everyone in the clients
are they
Yeah.
taxed? I mean, do they tax me on that, or am I only getting taxed when I sell the Texas?
right now you're taxed when the property is sold and the capital gain is realized.
Okay. So if I never sell it, I don't have to worry about it. But if I
you have,
do sell
you have
it,
to die.
eventually I'm going to have to
You have
pay
to die to get
taxes,
out.
what, to California and to Texas? Is that how it works?
I don't know that
Well,
Texas.
so Texas doesn't have state income tax,
Yeah.
so there's no state capital gains.
Oh, okay.
If you all flip that, right, if you had a 1031 exchange in Texas, there's no capital
Mhm.
gains that's realized on that. So you're just dealing with your federal capital gains. So keep in mind that even if California's coming after this money, the IRS is going to come for it too, because the larger tax bracket is on the federal side. I think, is California still like a 13.3% cap on their state income tax? I think in the top bracket.
That's it. I'd have to check, but
It's pretty high. I mean, comparably, Texas is 0 across the board.
Okay. So what is the federal capital gains right now?
So you have your short term and your long term capital gains, and then you also have capital gains that are dependent on asset type. So there's actually like a different capital gains rate for artwork. I think that one's at 28%.
What about real estate?
Real estate would just be a traditional either short term or long term capital gain. So if you're looking at doing a 2-5 rule, you've been there at least 12 months, you'd be looking at long term capital gains for the federal side. I'm not super familiar with the California's capital gains amounts, but I'm not sure if they have a separate capital gains tax percentage or if they just do it on their income bracket system. I moved out there, several years ago.
I think I just Googled it. It's between 1% and 12.3%. And there's
For California?
Yeah, and there's no
California.
distinction between long term or short term.
Oh, really? Okay.
Wow. Okay. So then what about the Fed? So you're going to add the federal tax or federal capital gains plus the state capital gains, correct?
Well, yeah, you're going to end up paying both to the two separate entities. So the federal capital gains it ranges from 0 to 20% depending on the amount. So 20% being your top bracket on the federal side of the capital gains.
Okay, and that capital gains you're taking, I guess, right? So if you're only like $100, it's in a lower bracket, kind of like your income. How as your income gets higher, you get taxed more. Is that kind of how it works? It's not a flat.
Well, you have to differentiate between your long terms and your short term capital gains because you are going to get different amounts on that. That's right. So the long term is bracketed the 0, 15, 20, and then the 28 if it's the artwork on anything over 12 months. Anything before that, it's going to be taxed to your ordinary income bracket. So it's going to be put into whatever your taxable income for the year is, and then you're going to pay your aggregate of that off of the federal tax bracket system.
Yeah, exactly. Just like if I buy a real estate and I fix it up and flip it within that year, it's not capital gains, it's income.
Right.
They look at that as like a job, basically, kind of thing.
Right.
Yeah. Okay. That makes sense. Okay. So let's switch gears. Mortgage deduction. So when I have a mortgage on a property, let's say I'm paying I don't know, let's say 50,000 a year in mortgage interest. Okay. Like, how does that work? How do I write that off? Is there a cap on that? I think we used to not really have a cap, or maybe we did. I don't know. But I think when I buy, I don't know, are we capped at like 1 million on loans?
Yeah.
I know there's some.
So it used to be $1 million. The Tax Cuts and Jobs Act reduced that down to 750,000 for single filers, or
750.
married filing jointly, and then married filing separately is going to be half of that, so 375,000. And I know when that came out, that was a big impact in California,
Oh,
particularly
oh,
just because of how high the real estate is there.
hold on one sec. So you're saying if there's only one owner, it's half of the 750,
No,
375.
if you're a single owner or married filing jointly, it's 750. If you're married filing separately, you have to split that 750.
Oh, okay.
Yeah.
Yeah, I gotcha.
Yeah. So similar to the
understand.
2-5
Okay.
rule, it's 500,000, but
Mhm.
for some couples, and it's not common. I mean, it's rare situations. Is it beneficial to the taxpayers as a married couple to file married filing separately? Typically, it has to be. It's usually beneficial when it's two high income earners, but more often than not, it's more beneficial to file jointly. So that'd be the 750,000.
Okay.
Yeah. So it's same
Why
amount.
would if I was married, why would I file single? Is there's some advantages in certain situations for that?
Well, you won't be filing single. You'd be filing married, filing separately. So it's
Well, yeah.
And what it is, it's just you have to calculate the tax difference. So you have different brackets based on whether you're single, head of household, married filing jointly, married filing separately. And there's certain situations with people's incomes and taxes that it is beneficial to file separately, but it's not very common.
I gotcha. Okay. I have seen it before on mortgage loans before. So
yeah, and some people claim that it is better because it's one of those things in taxes that's I spend so much time having to explain to clients what information they've heard is correct, what's wrong, and what's kind of half truths, and that's kind of one of the. There's been a trend going around for years that if you make over X amount of dollars, you should be filing separately, and it's one of those things. I mean, you could have your tax filer calculate both ways. Most tax software, it's pretty simple to see, okay, if I was head of household, what would my tax liability be? Okay, if I was married filing jointly, how different would that be than filing separately? Some tax professionals automatically do that for people, but you get a lot of people just gain bad information, especially with how prevalent there is with social media and all these life hacks for taxes and life hacks for real estate. You get a lot of wrong information out there, or a lot of times they kind of get half of it right.
Yeah.
I just had a conversation with a person who had been approached about using a unincorporated association to avoid paying personal taxes. And the reference material was all on YouTube.
Yeah, that kind of sounds like one of those sovereign citizen ordeal.
It's something like you opt out of paying taxes.
Sounds good in theory, but
yeah,
not very.
A few times. What's
it's
crazy?
a conversation to have with the agent, and you say, "Well, I opted out."
Yeah. There's like YouTube videos showing how well that goes over in courts too, and typically the sovereign citizen arguments, and there's a difference between a legitimate tax loophole and loophole's not a term a lot of tax professionals like anyways, because if it's there in the code, that's not a loophole, that's just the code. Right. But there's a difference between that and people having these really far-fetched differences of definitions of, I'm not actually a citizen of the United States, I'm a resident of this particular state, and because of that, this law doesn't apply to me. And as far as I've seen, that doesn't go over too well when it goes to litigation. So
do they try to get out of paying taxes and everything, right? And
yeah.
And you come across them with as citizens when she was a cop, and like, we're a sovereign citizen, we're sovereign, you can't do anything to me.
That's a good argument if you want free housing and 3 square meals a day.
Yeah.
Yeah, interesting. But so what about so can I write off my, you heard the homeowner association, homeowner insurance, and my property taxes? Are those all able to be written off as
Sure.
well? Or
Yeah.
tax deductions, I should say.
So property tax is a universal one. So you can write off the property tax on your primary residence. There is a limit on it. Right now
There is.
the limit is $10,000, but it's not just $10,000 of your property tax that's at that cap. It's property tax, state and local income, and then state and local general sales as well. So you're at 10,000 cap for the three of those put together. Now for now that's when it's your residence. When you're talking about a rental property, now you're talking about business income, business expenses, or in this case specifically rental expenses. So when it's primary residence, you cannot write off your HOA dues or your homeowner's insurance premiums. But when it's a rental property, you can. Those are coded by the IRS as rental expenses or business expenses associated to that rental property. So if you're talking about investment property, you can write off all of that. If you're talking about your personal residence, you have the up to 10,000 of the property tax, conglomerate with the other taxes in that section, but not on the other two items.
Okay, that makes sense. Yeah, because any expense, if you have a rental property, that is a business basically, and any expense attached to that business, you can write off. It's a tax deduction, correct?
Well, any legitimate expense you can write off. Yeah, this is about half my job is going through the questions of, well, what about this thing and that thing? It's like, okay, well, the Honda probably, the Ferrari probably not. And again, it's a lot.
What if I'm a realtor and I do luxury real estate and I have to drive my clients around in a Ferrari?
Yeah, it's one of those things where, and I tell clients this all the time, especially when it comes to taxes, and this is the case in law in general. The number one thing you'll hear an attorney usually say is it depends. I'm sure, Chris, you've said that a million times in your career, but particularly in tax, I mean, really, really specifics matter. What kind of business you do, what kind of vehicle, what sorts of expenses, how are you using it, how are you backing that up, and then it's not just a question of, okay, what does the code say or the IRS publications say, but you also have to look at case law of like, okay, has this been challenged in U.S. tax court before? What was the ruling? Were there similar events and details to it, for this and that? And so, and you have certain items that are expenses or write-off expenses that people do. They're just more likely to be a flag with your tax returns. And, company vehicle is a big one. And then also clothing's another big one. People think that, okay, if I buy this suit and I'm a high-end realtor and I have to look nice and dress nice and look like I do well. Okay, I bought a $5,000 suit that I use it for business Monday through Friday. Well, the tax code's a lot more specific than that. Than just can it be used for business use? It has to be exclusively used for business use, and not just
isn't it like you have to have like your logo or something on it, and then you can write that off and even write off the dry cleaning just on that one shirt, or if you have 5 of them or whatever? Is it something like that?
You don't necessarily have to have your logo or business name on it. That certainly helps. But what it has to be is it has to be not usable in other purposes besides your business use. So things like uniforms work. You have a uniform for your employees that say your company, plumbing company on it. You can't wear that to a wedding. I mean, you could wear something. I mean, you could wear a flip-flops and a bikini to church. Doesn't mean anyone's going to do it. So, it's kind of the same thing with a suit. Is if you have a nice suit for your business, well, you can wear that to a gala, to a party, to a wedding, if it can be used somewhere else. But if you have a T-shirt that has your company logo on it, that's considered a uniform. It doesn't have a proper use in another environment. So it's one of those things where people typically get the information half correct, but it's the half that they get wrong that's going to end up in an audit, and then you're going to get disallowed it. And then on top of that, most people just don't keep receipts or good record keeping. Because you could be correct, you could have all legitimate tax write-offs and expenses, but if you get audited and you can't prove it with receipts, then you're going
I
to be
see.
disallowed a lot of those deductions. And
Yeah.
what a lot of people think is, oh, well, I have my credit card statement, and the IRS doesn't, care for that. They want actual receipts of the expenses.
Oh, really?
Yeah,
So statements aren't good enough to keep, huh? You need the actual receipt, huh?
correct. Yeah,
All right. Good to know.
yeah. So I remind clients all the time, they'll update me on a conference they're at or a business trip they're doing, and I'll always tell them like, hey, sounds great, good luck, make money, keep your receipts.
Yeah. Yeah. Okay. I gotta definitely be better at that then.
And and
Um,
anything goes with if you're talking about medical expenses too. If you're using HSA accounts, even down the road to reimburse for medical expenses. A great way to do it is just you keep a Google Drive folder of your receipts for medical expenses, and then when you want to draw down your HSA, even years down the road, you're going to want those receipts to get that reimbursement. And same thing,
okay.
credit card statements, bank statements are not going to be enough. Not with the IRS.
Interesting.
It's a
Okay.
lot easier to store this stuff now than like the old shoebox days.
Yeah, it's easier, but I still get way too many shoe boxes and receipts as it is.
Yeah.
Well,
Yeah.
the problem now is
Typically you want to like put them.
the thermal receipt
Sorry.
paper fades after not that long, like a year later. A lot of them you can't read them.
Yeah. Yeah.
Oh. So you want to take those receipts, scan it, have a system in place, have like a Dropbox hard drive, whatever, and sort them by years. Maybe month, I guess, doesn't really matter as much. Just sort them by year, maybe sort them by different, like whatever, business receipts and mortgage receipts or whatever, things
Yeah,
like
I
that.
mean, if you're that organized, I mean, that's ideal, right? But the problem is most people
Mhm.
aren't, and especially if you're
Yeah,
self-employed
of
or a
course.
business owner. I mean, you're spending so many plates at once. So what I tell my clients is, hey, at bare minimum, when you get a receipt from something you purchase, especially when you're talking about like on a business trip, so it's like almost everything you're buying is going to be an expense when you travel, your flights, your hotel, your rental car, your gas, all some of the food. What I tell my clients is take a picture with your cell phone. Because then at the very
Yep.
least, you can, I mean, that, I have an Android, but I know I know Apple has their own cloud system too to back up. So, one, the photos are going to be backed up and saved somewhere else off your phone. And two is if you're trying to go back and remember an expense, well, you're going to remember, oh, yeah, in October, I went to New York for that conference. Okay, you look at your photos. All right, there's me with the Statue of Liberty. Okay, yeah, there's that receipt, that receipt, and that receipt. And that's fine.
I know there's
You don't have to have the physical receipt still. You just need a photo of it.
Okay.
Yeah.
Okay. I know there's apps for that too. I think that would be much easier just having a specific app you can take anytime you get a receipt, you just take a picture of it and then you don't even have to think about it. You could toss it.
Yeah. There's a ton of options out there. I mean, I've used a few in the past with employers I've had where you go on a trip and they attach the company credit card to the same account and you attach the receipts to the actual transactions, and it's really helpful. And there's probably free options out there. I don't know if QuickBooks has a receipt function or not with their app.
They do,
but
pretty sure they do.
Yeah, they do. But there's a ton of options, and it's all about just personal preference and just knowing, okay, how good are you at staying on top of this? If you're a shoebox kind of person, maybe start off with, okay, let's at least keep the receipts and take a picture. But if you're someone that you're doing your own bookkeeping, you're doing all your own, accounts receivables, accounts payable, then yeah, you could probably handle, finding an app that works for you, or even finding bookkeeping software that ties it right in, and just the better bookkeeping records you can do, the better it is. Not just when it comes to time for tax season and saving money, with your CPA or your tax filer, but particularly if you ever get audited. The better record keeping you have, the more smooth that process is. Because it's already not going to be a fun process at all.
Yeah, for sure. Okay. Now, what about if you're like a business owner or maybe, I guess if you're a business owner or sole proprietorship, how do you write off your, you can write off gas? Can you write off your car payment? Does it have to be a lease versus a purchase? I know like that kind of used to be a thing. I don't know if it still is. But I
So,
work with
so it
writing off
doesn't have to
auto.
be a lease. Yeah,
Okay.
either one could be a business expense, and there's two methods
Mhm.
to it. There's the mileage method, and every year the IRS puts out what the mileage amount is. I'm kind of guessing here, but I think it's like around 55 to 60 cents a mile. It's been in that kind of realm for the last couple of
Yeah.
years. And
Are
then
you
the other
capped
method,
off on how many miles you can write off?
not that I'm aware of. No, there's no cap on the mileage. But again, it comes down to record keeping. If you keep putting
Yeah.
down, you drive 30,000 business miles a year, and let's say it's at 50 cents. I mean, that's $15,000 in write-offs. I mean, that's a lot of money.
Oh, wow.
And what happens is,
Yeah.
well, people will do that, and for 2, 3, 4 years, they don't get audited, and they just assume, oh, okay, well, I guess I'm doing it right. I'm just going to keep doing this. And then you get audited going back, and the IRS can go back. People think that you're only safe for 3 years. Well, it's 3 years, but there's exceptions to that. One of them being if you never filed a tax return. If you didn't file a tax return, then they can go back further.
Yeah.
I've had clients that have been audited going back 6 years, and for that reason, because there's no tax return. There's other things like there's fraudulent behavior and certain other conditions that allow the IRS to go past that 3-year window. But even within that 3-year window, they're going to come back and they're going to want receipts for everything. And big ones are going to be clothing for business expenses, company vehicle, excessive home office write-offs, and then independent contractors are a big one too, right? And I don't mean so much the argument of whether this should be a W-2 or 1099. That's not the IRS's realm as much, but more of you have a lot of people will say, well, I paid these guys in cash, or I paid this check to a 1099. Okay, well, where's the W-9 to back that up? Where's the 1099 form that you're supposed to send up to us to back that up? You can't just withdraw $10,000 on a business trip and then deduct the $10,000 withdrawal from the ATM. You have to actually show what was spent on.
Show all the receipts for it.
So
Right.
what some of the things I encourage clients to do is take photographs. So if you're going to have like a company meeting, like a board of directors meeting, annual meeting, that sort of thing, and you want to write it off, and you're staying at a nice resort hotel, that sort of thing, I tell them book a meeting room so that you have an actual meeting place. The name of the company goes on the hotel marquee. It says, the Ritz-Carlton welcomes, K&B Capital. Take a photograph of that. Take a photograph of your meeting. Now you have photographic proof that you were at a meeting, as opposed to spending the weekend at the Ritz-Carlton.
What if it's just me that owns the company and I'm the only employee?
Have a board of advisors.
That's still acceptable. So and he's spot on with it. I tell clients the same thing. Either keep records of what was discussed. Have a photograph of proof. I've a client that does photography. So literally they'll have photos that they posted the day of the rental space they use, and it's timestamped. It's the perfect proof of, hey, here's the timestamp of exactly. Here's the photograph that was taken in the room of being discussed that was rented for the business use. I mean, that's as about as great of proof as you can get. And this guy can do great with something called the Augusta rule. And this is starting to get more popular on social media and some blogs and stuff. But the tax code allows you to be able to rent your personal residence up to 14 times a year as income tax free. It's the Internal Revenue Code, Section 280A, subsection G. It's the Augusta rule. It's about 2 or 3 sentences long. It's been around since 1976. And where the huge benefit is instead of renting the room at the Ritz-Carlton, and you could write off you rent it for $500 for the day. Even if you're a sole business owner and it's just you, if you're using it for legitimate purposes, that's a business expense. But what you can do instead is you can rent your residence to your business and be able to not only receive that tax deduction for the expense from your business, but when you pay yourself the rental income, that rental income is now tax-free on your federal income tax return up to those 14 days. Now, it's very important that it still has to be a legitimate business purpose. And this is where people tend to get in trouble, right? Is they just say, oh, well, I rented my house and I had a business meeting. Okay, well, what did you do? What did you discuss? What did you work on?
Let me ask you. So right now we're doing podcasts. So am I technically renting K&B Capital from Brandon right now, my house, and this would be that rental day kind of thing? Is that how
If
that
that's the way
as
you
an
set it up,
example?
it absolutely could be, yeah. So, like
Okay.
my law firm, my law firm rents the Nate Mallory's residence, 14 times out of the year for, I'm an LLC, so technically it's a member owned business. So it's a members meeting. If you're a corporation, it'd be a shareholders meeting. I guess if it's LLC, it could be a manager run meeting as well. For just general consensus, everyone has heard of a board of directors meeting. So when I'm explaining to a client, I tell them, essentially you're having a board of directors meeting, even though it's really a members meeting or managers meeting. It just so happens that you're the sole board member, and that's irrelevant as far as it comes to whether it's a tax deduction or not. It doesn't matter if you have one owner or 100. If you're still, as long as you're meeting that threshold for legitimate business purposes, and there's certain tests that the IRS uses to determine that, and there's certain things that I recommend to clients to help solidify that. So like things I do is I create a single day lease contract for clients of renting from the taxpayer, so you as an individual renting it to your business, having a lease agreement for that, having an invoice showing the transaction, the rental amount, and then the key part that's important, and this is where people get busted a lot on like the having the child employee tax deduction, is you have to actually move the funds. You can't just say, oh yeah, I paid myself 10 grand in rent to use it for a podcast. Okay, well, where's the wire transactions? Where's the invoices to show that you actually moved $10,000 worth of money? Because otherwise, now what you're doing is you're getting into that world of piercing the corporate veil of, well, if you're just saying that there's these transactions, but there's no real difference in your bookkeeping, you're basically treating your business like your piggy bank, and you're treating your piggy bank like your business, and there's no separation. And now you're dealing with, and I'm sure Chris gets this a lot with the business side of law, of now you're dealing with some liability issues once you have that
I harp on this stuff, but that's why that's why you want to do minutes and resolutions, right? So if you have a meeting, you better have minutes and resolutions that go with the meeting. First thing an IRS audit agent asks for, they want your governing document, bylaws, operating agreement, whatever it is, and they want your minutes and resolutions.
Yeah. And obviously you have a requirement for those, if you're a C corporation, S corporation. I tell clients, even with the LLC, even as a sole proprietor, which is just your default business formation, it's not a formal entity, but you're still a business and can still have the same business expenses. I still tell them, keep a record of what you talked about, have a plan, have an itinerary. Or I tell them, like, if you have a tax concern coming up, or if we had a meeting that we needed to have, a perfect time to have it is when you're renting your residence for a business meeting and you call your attorney, or you talk to your CPA, or you send an email to your clients, or talk, discuss with your banker for whatever you have going on. It's having those record keeping and be able to show that it's a legitimate use. And then also just being within the realm of realism. So this actually did get tested in U.S. tax court just last year. It was kind of actually the first example of the Augusta rule being challenged on its own. The Augusta rule has been discussed in correlation with like rental property deductions, for decades, but there hasn't been like a very firm case kind of challenging it. And there was finally one. It was a group of doctors that owned a gym, and there were three of them. They each wrote off 14 days a year for the Augusta rule for their homes, but I think they rented their home for like $5,000 a day. And then when they went to tax court, they had almost no proof for any of the 14 meetings per partner for, I think it was like 3 or 4 years. So we're talking in total something like, well over 100 meetings. And the IRS ended up still allowing, or I should say the tax judge allowed, about a dozen, maybe 2 dozen of those meetings, which still shows that the tax deduction and the whole strategy is legitimate. And they still allowed quite a few deductions from it, but you have to be reasonable with the amount and be able to back up why that amount is valid. And then you have to be able to prove that you actually had the meeting you claim to have had. And when you have partners that live in different countries or different states, and you're claiming that you had a meeting at Bob's house in Florida, but I'm in Texas, and you don't have any proof that there was a Zoom call You don't have any emails that were exchanged. You can't even show that you had a phone call for a couple hours that day with each other. I mean, that's where you're going to get disallowed deductions and really fast.
Okay. So basically, just can't make stuff up. You have to have legitimate,
Yeah. Yeah.
legitimate
If you
proof.
sum up
Like
tax
I could
deduction,
show,
that's about as
yeah,
perfect as you can be right there. Don't make stuff up and just have some proof.
I could show every time I've done a podcast, but and say, hey, I'm renting this to my business, my house, because that's where I'm doing it at now. But if I'm not moving money, if I'm not paying myself, then it's kind of invalid. Is that correct? Because I don't have the money
Yeah, because
also proving
you're
it.
essentially taking a deduction, and even though it's one thing if you're a sole proprietor or LLC or S corp and you're a pass through entity, you might have a little bit more leeway with that of saying, okay, well, I reflected on my Schedule C, but I didn't actually make a transaction. But at the end of the day, what you're doing is you're saying, hey, this transaction happened, and I'm going to take not just the deduction from it, but I'm not going to pay the income tax on the rental. But then there's no actual paper trail of that transaction taking place. I mean, that's not necessarily fraudulent, but it does not look good. And it's a simple fix. I mean, if you run a legitimate business, you should have a separate banking account anyway, not just from a professional standpoint, but liability of having that separate from the business and the personal. You just do a transfer. If you're renting your home for $250 for the day, you do a transfer from your business account to your personal account for the $250. I create an invoice for my clients where it's from them, the taxpayer, to their business, invoicing for the rental. And then I also do a lease agreement for them, outlining here's what the property is being used for, here's the terms. And so that way, if they get audited, it's, hey, here's an invoice, here's a contract between the homeowner and the business, and here's proof of the transaction happened. And here's their tax return where, it got filled out, the way it's supposed to be. You want
what's the max amount like I could rent my house to myself or to the company? Like, how do you determine that?
Well,
What's fair?
There's no statutory limit listed at all, and for most of these deductions, there aren't. You have some things like we talk about the property tax being capped at $10,000. Some things have a limit, but for example, realistically, there's no limitation on business expense for travel. You might only travel a few times a year, maybe it's a couple $1,000s, but if you run a massive corporation, you might have millions of dollars of legitimate travel expenses. There's no cap on it. Well, the Augusta rule, same way. There's no cap on the dollar amount, but there's a cap on the days. So if you rent your residence for more than 14 days, you no longer get the Section 280A subsection G exemption, and it's now being treated, as if it was a rental property. But it has to be realistic. So what some people have done, or what I've heard some people online doing, is that they compare it to, okay, what's an Airbnb rent for the same general house in the same general neighborhood for the day. What I like to do personally is, going back to what Chris talked about, the hotel, is I look at the same zip code and I look at conference rooms in business centers or hotels. I see, okay, I can rent a 4-person boardroom for $60 an hour. Okay, so for a full day, that's $480 right there. I'm renting a 1,500 square foot house. It comes with a bathroom and amenities. So it depends on the particulars, and it depends a little bit about what you're using it for and what your business does. It's all kind of a system of finding that legitimacy, and obviously every taxpayer wants to pay as little taxes as possible, but you want to make sure you're doing it in one, a legal and correct way, but two, a way that you don't want to be a high audit risk, and if you are audited, you want to be able to prove that you had legitimate expenses. And where a lot of people get hit with these early on with businesses, or even later on, is having to challenge the hobby loss rule of the IRS, which is basically you have to be able to show that your business is in the business of making a profit. Whether it actually produces a profit or not is not as relevant, but there's a factor test. There's like 7, 8, or 9 factors, which means you don't have to pass all of them, but there as a correlation of all of them put together to determine whether your business is essentially legitimate or if your business is a hobby. If you say you have a business that you buy gym equipment and then you sell it, and that's your business, but really all you did is you made like an awesome home gym in your garage with, $20,000 in new equipment, and you haven't sold a single thing in 5 years,
Yeah.
you're probably not going to pass the hobby loss rule. But that's not to say that, if you own a cattle ranch and your profit is made by selling cattle, well, the first couple of years, they're living things. They take a while to grow to size and feed and get the system in place. So it's not expected for that kind of business to have a profit, probably even in the first few years. So it does depend on the type of business, and even, compares to what do other businesses in the same trade do, and same thing with your expenses. When they're comparing whether expense is considered reasonable to the tax code, one of the things that is often looked at is, okay, what do similar business owners in similar industry, do they have those kinds of expenses? If I'm a lawyer and I say, okay, I wrote off, a laptop for my office. Okay, well, here's all these other attorneys, and that's common. But if I wrote off a private jet for a law firm, and that's just not a typical expense that's needed to run the practice of a law firm, it's going to be questionable. It's not necessarily guaranteed that it's not going to fly, and, no pun intended there. But
hopefully it does fly.
That was good, buddy. That was good.
Additional factors into it, and that's why I always tell clients, like, the specifics really matter, because I can have someone with the same car, the same mileage, the same travel expenses, but they're in two different businesses in two different industries with two different sets of books. It's going to depend on, okay, which one is going to lean more towards being able to be written off or not, and
Okay.
Again, everyone's trying to pay as little as possible, so you always get people kind of cutting corners on stuff of, and commute's a big one, right? It's, okay, well, I own a business now, so I'm going to write off when I go from my house to my office. Well, no, you can't write off the commute. But then, okay, well, if you're a realtor, you're showing houses, and then it's, okay, well, what's actually my office? Is it the office that I go to at the headquarters of the brokerage, or is my office actually my home office I work out of? And there's, there's systems that you can play with there to kind of benefit that more, but you have to be careful that you're not just, completely cutting corners. A lot of times, if it sounds too good to be true, it might be.
I see. What about writing off a home office? I know that when I'm doing loans for self-employed people on their Schedule C, I think it's line 30. There's a home office write-off, and I can actually give that back as income to my clients. So if that net 31 is showing 100 grand, and then they have a $30,000 home office write-off, I can give them $130,000 in income, which is cool, but I don't always see it. And I know some of my clients often use their home as their office, but they don't always write it off. And I wonder why that is.
Again, it depends on the specific of each loan, but I'd imagine if they're not writing off, it's either one, they don't know that they can, or, they're in some sort of circumstance where it doesn't qualify. One of those is, if you're using the Augusta rule, it's in lieu of the home office. Because essentially, if you're to have the home office in the Augusta rule, well, by definition, if you're using that home office 5 days a week, 50 weeks out of the year, you've rented it to your business more than the 14 days. Now, the trade-off there is there's two ways to calculate your home office deduction. The one that most people hear about is taking the percentage of the square footage and then using that percentage towards, relevant expenses. So if you have a 1,000 square foot house and you have a 100 square foot room that you use for your office, and again, there's requirements you have to meet about exclusive use. And there's been tax court cases where they've disallowed certain square footage because it was a half bathroom in the end of the house that's next to the office, but that half bathroom still gets used by guests when they come and visit when they're not working. And so therefore it's not, clear exclusive use of it. And it's always been challenged back and forth and stuff. But essentially, you take that 10% square footage of the home office to the house, and now you're deducting 10% of your rent or mortgage. You're deducting 10% of your electricity, your gas. And so that's one way to calculate it. The other way that is the simpler way is the IRS has a calculation available. So they'll let you deduct $5 per square feet up to 300 square feet of use per year. So essentially, they cap you at $1,500 write-off. But then the trade-off with the Augusta rule is, even if you have a moderate-sized place, and for the Augusta rule, you don't have to own it. It doesn't have to be a house. It doesn't have to be a home. It actually even stipulates in the code, I believe it can even be an RV and maybe even a boat. I'd have to go back and read it again, but it just has to be a residence. It doesn't have to be something you own. So it can be an apartment you rent and you can still use the Augusta.
Yeah.
And the
Okay.
trade-off with that is, one, now you're not having to calculate square footage and keeping track of, okay, what percentage of the phone bill can I write off? But the trade-off being, even if you conservatively can only write off, $200 for the Augusta rule, you do that, 14 times out of the year. Now you're talking about $2,800 write-off instead of $1,500 write-off using the simplified IRS calculation for the home office.
All right. So you wouldn't do both. You would do one or the other. Figure out
Yes.
which one works the best way. Okay. That makes sense. That's what I was wondering.
And,
Cool.
and more than likely, I mean, specifics always matter, but more than likely the Augusta rule can be more beneficial to business owners
It sounds like
than
it, yeah.
home office deduction. Yeah. Now the difference is it's more complicated. I mean, you have to make sure. I mean, I talk about all the stuff I do for my clients to make sure. Okay, if we get audited, this is going to be pushed through and we'll be okay. It's a lot more.
Yeah.
And it's something. I mean, I tell people all the time is there's pretty much nothing an attorney can do that you can't represent yourself and do yourself. What you're paying for isn't for a gatekeeping ability to do something. You're paying for the knowledge and experience to, hopefully do it correctly. So we do that a lot with deductions too. Is most of what I do, my clients could do it themselves, and some do. Some do their own bookkeeping. Some do their own P&L reports. Some of them just dump receipts on my desk every couple months and have me handle all of it. But the Augusta rule is one of those ones that you want to really make sure that you know what you're doing with it, because otherwise you're likely to eventually be audited on it, and if you don't have your I's dotted and your T's crossed, you're more likely to be disallowed at least a portion of the deduction that you claim, which now means you're talking about back owed taxes and money that you didn't account for paying taxes from what could be as much as 3 years back or further if you hit certain essentially missteps to allow the IRS to go further back than the 3-year window.
Okay. Yeah, that's awesome, man. So much great information here. I'm so glad this is all being recorded because I'm going to have to watch it like 5 times. Let's switch gears a little bit. Another question I had for you was I wanted to know, when I refinance somebody, what can they write off on that refinance? Because there's escrow, title fees, things like that. Is any of that, are they able to write any of that off? I do remember there was you can write off points. So if I charge a point, maybe you can write that off. I don't know. What do you know about that?
Yeah, as far as the escrow fees and stuff, I'd have to look into that. I don't deal with the mortgage side for write-offs often. It's usually, most of my clients have already bought a home, so we're just dealing with, the interest, and we're dealing with the, investment, rental property write-offs and stuff. But the discount points, that is something that you can deduct. So you can deduct mortgage interest points, but you can't deduct loan origination points. So it has to be a point that's actually reducing the mortgage interest rates, which if you think about it, it makes sense, right? Because if you're able to write off your entire interest on your mortgage payment, and if you were at 7%, your interest payment is higher than if you bought points and dropped it down to 5%. So you're essentially missing out now on that deduction you would have had long term from paying more interest. So you're going to front load it with a deduction for buying the points.
Okay, so that totally makes sense. So basically, I would assume with what you just said too, escrow and title is not deductible, but I could be wrong. But that's just my assumption based on what you're saying. Because if you're saying you cannot write off, let's say I do a loan for you and I say this loan's going to cost you 1 point. That point pays me basically. You can't write that off because it's not really tied to your interest. So what a discount point is you're basically buying your rate down. So if I'm going to give you a 5% rate, but you buy it down to 4.5 and that costs a point, that's a discount.
Right.
Discount point, which is technically interest. You're buying your interest up front, so then you can write that off.
Yeah, exactly.
Correct.
Again, I'd have to look at the other stuff, but I'd be surprised if that was able to be deducted. Maybe for a investment property that was already determined as an investment loan, but for a personal residence, because the reason you write
Probably
off
not.
the interest on the mortgage is that the IRS, or the tax code traditionally gives us an ability to be able to write off interest on certain debts, and that's the whole policy behind the mortgage interest rate deduction. The other parts, it's not associated to the debt. Having to pay a transaction fee or having to pay a banking fee. Well, I mean, banking fees for business can be right, but having to pay a transaction fee on a loan isn't actually associated to the debt; it's associated to the process. And traditionally, we're given exemptions or deductions allowable on debt payments.
Okay, that makes sense. What other whatever is there any other write-offs we didn't bring up when it pertains to like home ownership? We can kind of delve more into investments, property, and depreciation. We didn't really talk about that. So tell me a little bit about how the depreciation works.
Yeah. So
and what it is.
Yeah. So depreciation is it's basically a long-term tax write-off to something that you would write off initially, right? So you purchase $10,000 worth of inventory that's a legitimate tax write-off, or inventory might not be a good choice, but you buy office furniture. Furniture is actually another possible for depreciation, but you buy items that you would write off for $10,000 for that year. You get a write-off right then. But what the IRS doesn't allow is you buy a building for $1 million. They don't let you write off the $1 million up front. It would, you'd have people just front loading this massive tax write-off, and there'd be so many ways that you can use that to your advantage to basically kind of just constantly being offsetting all of your income. So what they allow is they allow depreciation of certain assets, and there's a few requirements for it. One is it has to be property that you own. It has to be used for a business or income producing activity. So it can't just be for personal use. Now there is a possibility that if it's partially for personal use, partly for business use, that you can still depreciate part of it. You have most people that have a business vehicle are still using it for some personal use. So it's, there is an ability for that. It has to be expected to last for more than 1 year, and it has to have a determinable useful life. And so the code actually provides for certain items that they determine what that useful life is on it. So one of the more common ones is a home. Is you're able to depreciate this asset over time. Essentially, what you're doing, instead of being able to write off you buy a condo to rent out for Airbnb, right? You form an LLC, buy this condo, $250,000. You're not able to write off the $250,000 expense in 2024 just because you bought the condo in 2024. You have to depreciate that amount over its useful life. And then there's formulas that the tax code provides, or actually it's probably the IRS publications that have it. And there's two main methods to depreciate that asset over it. But as far as it for a personal residence, you're not able to depreciate that because it doesn't meet all the requirements. It's not for a business or income producing use.
So one of the things I just learned about last couple of months is if it's a short-term rental, apparently you're able to engage in what they call cost segregation, which allows you to depreciate certain aspects of that property faster. And the idea here is that a roof lasts a certain period of time, a hot water heater lasts a certain period of time, and some of these things don't, they get replaced more frequently, more often. And there's a gentleman up in the Bay Area this is all he does, is he works with people who acquire short-term rentals, and he works with them on a cost segregation plan, which pushes a lot more depreciation into the first year or two. And how effective that is, I don't know, but it was an interesting conversation.
So with the depreciation on real estate, obviously on investment real estate, you're depreciating that over 27 and a half years. Is that what it is?
I think that's right. Yeah, 27 and a half.
So basically what we're doing is, if I buy a $500,000 house, I divide that by 27 and a half, and that's the depreciation I can take every year. Is that how that works?
I think technically you can only depreciate the structure.
The structure. So you're not going to take the full
purchase
price.
The land doesn't depreciate.
is not depreciable.
Yeah.
Okay. So you're going to deduct the land. And then, so if I bought it for 500 and you basically look at the tax assessment, it usually shows you what the land is worth. So let's just say the land's worth 100 grand. So then I'm going to depreciate 400,000 over 27 and a half years. And then that amount, whatever that is, divided, because I can't do math like that in my head. And so whatever that is, that's what you're going to claim every year that you own that property. Is that correct?
Yes, there's a second depreciation method that's used that's it's more common with vehicles. It's kind of a tiered approach to it. That's not a straight line divide. I'd have to go back and look at notes to see which ones exactly gets used on the investment property depreciation.
And the bookkeeping gets a little bit complicated because when you do replace the roof, now you're back to depreciating a part of the structure. So I don't know what it costs to put a roof on a house, but let's say it's $20,000. You just put another $20,000 in there, and that roof has a finite, useful life.
Yeah.
That's why I just give it to the accountant and say, we'll figure it out.
Well, that's Nate's job, to do the research and figure it out, right?
Yeah. Well, and I have an accountant on my team that does the tax return side of stuff. So I try to deal with more of the higher level tax strategy of it. So there's some stuff that I'm involved with, but I'm not actually the one that's doing a lot of these depreciation calculations. It's more of, okay, let's look at the whole picture of a client's asset situation and okay, which direction is going to give us the most optimal tax advantage, and then from there you have different members of my team that handle different sections of it.
Okay. Yeah, that makes sense. So you're not a CPA, you are a tax attorney.
Correct.
And those are different. So you're looking at the big overview, and then basically you would work with a CPA and he would kind of finish up the small details kind of thing. Correct?
Or not even necessarily a CPA, but a tax filer. So what's unusual with my law firm doing tax law is that we do tax returns in-house. That's not common with law firms, but we offer kind of like a one-stop shop financial service. So I have clients that will come in for a tax return, and then they end up becoming a client for tax strategy or for a little bit of business law. If they're in Texas, doing estate planning, wills and trusts, because pretty much anything that ties into long-term tax strategy. And it just made sense when I started out that, okay, well, why should I keep outsourcing clients to all these different, professionals? And then now I'm trying to, talk to 2-3 different professionals at once to get, clients a plan in place. If we could just do 40 of it in-house. So with that, I have a tax filer, I have a bookkeeper, because it doesn't make sense to pay, an attorney their rate to, be doing your bookkeeping or, even filing a tax return. It's too much money. So, I do the part that I need to do the higher level stuff, and then have my team, take care of the returns or take care of bookkeeping for clients' businesses.
And one of the Achilles heels of all this is if you work with a tax strategist and your tax preparer, the one who's filling out the tax forms, if they're not on board, if they're not plugged into what that strategy is, there's a very good chance that it's going to be a mess. So I always insist whoever's doing the tax strategy has to, or whoever's going to be doing the filing has to be part of that tax strategy team, whether they're in-house or separate. But you need to make sure they know what the game plan is.
Yeah, and you see it, higher net worth individuals, right? When we're talking about people that have pretty significant assets, typically a financial team includes a estate planning attorney, a tax attorney, a CPA, or some form of accountant or tax filer. Can even be an EA, and then a lot of times there will be a financial advisor, as part of that too. And now you're talking about 4 different professionals with 4 different fees, 4 different schedules, and trying to get them all on board with the same plan. I mean, we've all done group projects before, right? There's always someone that's hard to get a hold of. There's always someone that misses something. And the problem is, eventually, it falls on the taxpayer to be liable for. When you sign your tax return before it's filed, you're taking responsibility that the information in there is accurate and true. Now, there's certain things that, I mean, if a tax filer is just fraudulent, right? And there's been cases of them just, putting child tax credits for clients that have no children, and then, pocketing the credit money from it. That's different. As far as, hey, you didn't implement the strategy we talked about, or this, this didn't get put in the way it's supposed to, ultimately the liability on a tax return falls on the taxpayer, not the tax filer.
Mm-hmm. Well, dude, I could see you and Chris, a good duo there, because Chris does a lot of trusts, and, he's all trust and, LLC establishments, things like that, amongst many other things. So maybe you guys could both be a good resource for each other.
Yeah, actually, it'd be great to have an attorney based in California I can refer clients out to. So, one nice thing with tax laws, I can help clients in every state. I'm not restricted to just Texas because it's federal code. But when I have clients that have business in California, I'm dealing with their tax strategy, tax returns. I can't deal with their specific business law issues, because of the way the licensing is. So yeah, so having someone I can refer out for that stuff would be fantastic, Chris.
Perfect.
Chris, you're a California attorney. Are you in other states as well, or?
Yeah, well,
I mean, I know you live in Colorado at the moment.
Right. So right now, I'm licensed in California. I've been licensed in California a long time, and I'm looking into becoming licensed in Colorado. Unfortunately, that means having to take the Colorado bar, because if I had I think it's like 5 years, and now we have what they call a uniform bar exam, which did not exist when I came out of law school. You can get reciprocity. So what I'll probably do is take it here in Colorado, and because that's a fresh bar admission, and because I've been practicing more than 5 years, I think I can go to Texas and get reciprocity there. I already have clients in Texas, and look at it in one or two other jurisdictions that would be advantageous. I set a lot of stuff up in Wyoming, so maybe that makes sense. And but it's the state law varies from state to state, but usually it's not that different, and you can figure it out. The one exception is Louisiana. That's all Napoleonic code-based stuff as opposed to English common law. So, and I've done some work in Louisiana. But I hired a local lawyer, and I said, you need to walk with me on this. But there's always a way to make these things work.
Yeah, for sure.
I've even got my stuff.
Cool, man. Wow. Yeah, we definitely went over the 30 minutes, but there's so much information, and I could sit here and talk for another couple hours, but I don't want to do that. I know you guys are busy.
You can chop this one up.
No, I mean, yeah, definitely. But no, thank you so much, Nate, and Chris, always. Just so people, if people think your services can benefit them, like, how would they find you?
So there's my website, themalloryfirm.com. It shows some of the different services we have, or I could always give you my email or phone number for people to call me here in Texas. But I can represent anyone in any state for federal tax issues. I have quite a few clients in California. They're small business owners starting up and doing tax strategy, and then obviously Texas law for estate planning, things like that.
Yeah. Okay, cool. And then Chris, you're at CSL Law, or no, CLS Law.
CLSLAW.com.